Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about how tariffs and the whole trade war are affecting mortgage rates, even as we look at job numbers and inflation. Logan, welcome back to the podcast as we go through some incredible data today, from the inflation data to what's happening in the 10-year yield. Welcome back.
Sarah Wheeler, I'm going to say something that might sound very controversial, but if you've known me since the Peloponnesian War, if you know to be the detective, not the troll, if you know it's about labor over inflation, then what I'm about to say is pretty consistent with the last few years going into this year, and even going back to 2018 and 19, and even my first article about manufacturing under President Donald Trump in 2016 of December. Mortgage rates would be slightly higher today if we had no tariffs. What do you feel about that?
That's interesting. I guess my question is that because tariffs are sort of doing a number on the economy, and so it's strangling growth?
So if we go back to 2022, the end of the year, the whole, sipping of the eggnog, and the Federal Reserve chose to be modestly restrictive. We have to remember that the Federal Reserve actually had forecasted a recession in 2023. They had like a 4.6% unemployment rate, and their staffers were like, "Yeah, we'll have a mild recession." During that time frame, the growth rate of inflation fell much faster than they had forecasted. And even with that, and that the labor data was holding up better than they thought, they went hawkish toward the end of the year. It sent the 10-year yield up to 5%. We had 8% mortgage rates. And they had a little bit of a panic, because I don't think that's what they thought they wanted. But the only reason they cried uncle and said we're stopping the rate hike is because bond yields went up on them. So that was 2023. In 2024, remember when the 10-year yield got low and we had 6% mortgage rates, and Neil Kashkari said, how are we supposed to balance an economy if people are having sex and buying homes? We can't have mortgage rates at 6%. 6%. We're not 3, 4, 5s. We're talking about having the biggest crash in home sales ever. And then 6% rates was too much,
Right.
But what happened in 2024, they kept on saying, well, the growth rate of inflation, we're not confident, whatever Mickey Mouse stuff they were saying. In any case, the growth rate of inflation was very tame. We had 2 handles on PCE, 3, 6, 12 months. Didn't matter. The only reason that they even cut rates in 2024, because remember, they were saying, we might be near neutral policy. We're not that far off. The labor market, all the revisions and the lower data forced them to cut. And Jerome Powell said himself, we waited too long. So by that time, the 10-year yield got well ahead of Fed policy. Remember, I care about where Fed policy is, because that's how I look at each economic cycle. And then here comes 2025. But what's different is that we had a trade war. And what did I say about the trade war? I went through the first trade war tap dance in 2018 and 19. And we had corporate tax cuts and everything. And business investment went to zero. The economy was not performing well. That Trump back then was saying, we need lower rates. We need lower rates. The economy's so booming that we need lower rates. No, trade wars aren't easy. Goes back to the December 2016 article. So here we are. Then we had Godzilla tariffs. Trump didn't do the first wave. He just basically went straight Godzilla tariff. What did it do? It took the 10-year yield down to 3.87% this year. The stock market went a bear market. Everyone was planning for a recession, because if Godzilla tariff stayed as is, nobody thought the economy could handle it. Case point number 1 this year, 3.87% on the 10-year yield. Here we are. It is Wednesday morning. We just had a bond auction. The 10-year yield is at 4.03%. Why are we here? Is it inflation? No, the growth rate of inflation is at 3%. It's the labor market, the economy. The economy was slowing down going into the year, and it slowed down even more. Why? What's the difference this year than last year? We went into a trade war. We went Godzilla tariffs. We're throwing stuff up in the air, hoping it sticks. And here we are. And if we didn't have Godzilla tariffs. If we had no tariffs, do you know what the Federal Reserve would say today?
What?
They would go, we are near neutral policy, which is what they said before the year started. And because we are near neutral policy, maybe 1 or 2 rate cuts. Maybe. And then Jerome Powell comes out and says, oh my God, well, if the growth rate of inflation is falling, we would have cut rates already. No, you wouldn't have. We've already had 2 handles everywhere.
So I think the reason that you're saying, is this could be controversial is because, you do have models that are based on the inflation, right? That's what's driving the Fed.
Christopher Waller and some other people said that the labor data is getting softer than they imagined. And guess what happened? The labor data was getting softer. They chose to ignore some of that data line last year. Manufacturing jobs were lost last year. Housing starts have been in a recession for a while. And, oh my God, what's going on here? How did residential construction workers lose their jobs? What's going on manufacturing? Homie, it's been here for 18 months. So how do we know this? Again, Stephen Miller, the trade policy of Trump, who said that the dollar was going to appreciate, which I don't think he thought that to be the case. In any case, the dollar didn't appreciate. It went lower. In any case, he is now going to be a Federal Reserve member. And he wrote down, well, the labor data is softer because we believe that businesses are not hiring because the trade war or the tariffs are creating a lot of confusion and chaos. Same thing in 2018-19. Okay, so nothing abnormal about that. What happened in 2018-19? When rates started to go lower, housing data started to pick up. When rates started to go lower and they made deals, guess what? Manufacturing data, I urge everyone, go back and read the first 2 months of 2022 data. Retail sales were up. Manufacturing data was up. Housing starts pre-cycle highs. Existing home sales pre-cycle highs. New home sales pre-cycle highs. Here we go. That is all expansionary data. But now we have the head trade person who's going to join the Federal Reserve who are trying to get rates lower to say, well, guess what? The trade war is creating, confusion and chaos with businesses and they're not hiring.
I think it's been confused also because we have, President Trump really trying to pressure Powell. If he could, he would fire him. We know that. He isn't able to do that. So he's doing an end run around him in very political ways, politicizing the Fed in a way that we have not seen before, at least not in a long time. And so I think that if you think that people are defending Powell, they may be trying to just defend the independence of the Fed. What do you think about that?
They're not defending the independence of the Fed. These are anti-Trumpers. I get it. Trump has that effect on people. I've waved myself off of politics, so I don't care. But as an analyst, I'm supposed to look at this data. And if you had told me a serious economic person would have said it's completely okay for manufacturing jobs to be lost, and then housing starts being a recession and permits being a recession, and all of a sudden be surprised that, oh my God, construction workers are losing jobs. And you're telling me that modestly restrictive policy, which they say every time, it's like people are deaf. I'm sitting here every meeting and they're saying, we are modestly restrictive. The labor market is solid. Homie said the labor market is solid. We have restrictive policy, and then literally all these revisions has it, but not all of them.
Right.
Not all of them. Christopher Waller and others said, hey guys, this doesn't look like a solid labor market.
Okay, so let's talk about this. Okay, so when we got the revisions, this is a question, right? There is a lot of questions right now about can you trust that data? Then the revisions came in, way more than people thought they would. So worse on a worse basis, right? As far as jobs created, how do you parse this? Because this sort of information, it could just be like, wow, the revisions came in bad. So that means we need to change policy on that. Do you think there's a larger issue here on you cannot trust the data?
You can trust the data. Everyone in the markets knew the revisions were going to be bad. Jerome Powell literally told us on TV, the labor data is going to have big revisions.
Right.
And even with that, you had Fed presidents that were saying the labor market is solid. What world are you people in? What? It's like the Truman Show or some crazy show. No, there is a civil war within the Fed because there are people out there who track different type of models, and they were like, "Hey guys, this doesn't look like a solid labor market." And then you got Trump running Godzilla tariffs all over the map. But we have $300 billion in tariff revenues. Whoa, boy, can you say government checks coming out soon? Can you say the housing plan is going to be no tariffs on anything coming in? None of that stuff isn't going to work. So we have two elderly gentlemen that are both been wrong out here, but Trump knew it. This is why they wanted lower rates right off the bat. They remember the first trade war. They did not go as what they planned. And now inflation was elevated, but rates are elevated. So why did I come on CNBC 6 months ago and say, hey, listen, the cure for tariffs, what Trump wants is lower rates? Because they remembered what tariffs did. Christopher Waller remembered what tariffs did to the economy. Tariffs are a tax, right? The company has to pay it, eat it on the margins, or they try to pass it on. The PPI inflation came out today, right? It had a big miss of estimates, but if you actually look in the internals of the data, you actually see the goods coming in. It's what we talked about in the last podcast, that the Federal Reserve is going to look at this. So we are here. The 10-year yield is at 4.03% because the labor data is getting softer. The labor data has been getting softer for over 24 months. We have sat here and said this. It hasn't broken yet. But the whole concept of 2022 was that they were going to wait until everything was so visibly possible that no one can miss it, that the labor market is softening. Then, and we still don't know if they're going to do this next week. Then they're going to go, okay, maybe the labor market isn't as solid as we thought. Maybe we might have to get to neutral policy. Neutral. We're not even talking an accommodative. Neutral policy faster. And that's why we're here. And if it wasn't for tariffs, Godzilla tariffs wouldn't have got the 20% bear market in stocks. And then, oh my God, hey, look at Navarro's out of the room. Come here. Get Trump to tweet this or say something about this. So really? So if I say that without tariffs, we would have been sitting here debating on one or two rate cuts, and we wouldn't have been having a little bit more softer data like Stephen Meyer, who's now going to be Trump's Federal Reserve person, come out there and say, oh, by the way, it does look like the labor market is slowing down because companies don't know what to do. We've been through this dance before. So everyone's wrong, right? Everyone is wrong here. And it's not easy, because if I go back to what I wrote in December of 2016, they're trying to do like this manufacturing thing where the dollar has to go down and we're going to have to import higher costs or try to build things within. Boy, it's a little bit difficult. It's a very, very difficult in a very short time frame. And this is why Trump's team wanted Powell out. They wanted as lower rates possible because it helps you fight against, a trade war that is very unpredictable. And they went even more unpredictable with Godzilla tariffs. So this is where we're at today. And it's not shocking to me, but boy, we've got a lot of people defending Powell and defending Trump on this. And we're sitting here wondering why the trend has been here for a very long time. You don't typically have manufacturing jobs losing jobs or residential construction losing jobs if the labor market is solid. He said it. Went on TV. And then we have Godzilla tariffs and have we signed any deals yet? No. Do we even know what we're doing, what we really want? No, we're just making stuff up. This is what it is. It is chaos. We wouldn't be here if we didn't have the chaos of Godzilla tariffs. So we have to incorporate this out going out in the future so we know where bond yields and mortgage rates and everything are going, because mortgage rates would have been slightly higher today if there were no tariffs, because the Federal Reserve would have still been modestly restrictive.
So this is the question that I often have on this podcast, that it's just confusing to me. Like, Trump wants lower rates, but he also wants to say that the economy is doing great. It's like, if the economy is outperforming and doing great, if we're not losing all these jobs, then then you're not going to get lower rates. The only way you get lower rates is if the economy is not doing well, if we're losing too many jobs. And that's why people in housing, like, it's a conundrum because of course lower rates helps everyone in housing, mortgage, real estate, title appraisal, whatever. You sell more houses. No one wants people to lose their jobs. No one really wants a recession. But the truth of the matter is you can't have like a booming great economy, everyone's got a job, everything's great, and then that's why we should lower rates. Those two things don't go together.
That's if you believe you need to be modestly restrictive. See, with me, it's different, Sarah. I've said this all along. I would have never hiked rates above 4% because the disinflation that was going to happen because of global pandemics were going to be there, and the Feds would sit there and go, "What do we do? The growth rate of inflation has fallen faster than we thought. We have two handles on 3, 6, 12-month PCE, and like literally 18 months ago, I went on TV and said the Fed funds rate should kind of match this. They didn't. They raised their inflation expectations because they knew tariffs would have goods inflation, and we're at 3%. The Fed got their target, right? And we're sitting here having one person say solid labor market, and we have another person, it's the greatest economy ever. And now one person says they're too late. They need to cut rates. The other person goes, I can't wait to hear what Powell says now. I cannot wait to hear what Powell says now. So they're both wrong. You cannot inflict that much chaos within a short time, and you cannot sit here and tell people it's a solid labor market when literally 5 or 6 people of your own crew are saying, hey, it doesn't really feel like a solid labor market. The only reason the 10-year yield is at 4.03 is that the labor market was getting softer last year. Population growth was not the issue last year, and they've already revised those numbers down because housing starts were in a recession, permits were in a recession, residential construction jobs weren't even growing. They've revised everything lower. Manufacturing jobs were lost. That's how we track cycles. Then the other side's like, hey, tariffs, the greatest economy. We're getting all this revenue, all this stuff. Cut rates, cut rates. We're going to get all of our people in there to cut rates. This is the world we live in. This is the reality. But we're here only because labor over inflation.
Okay, so if you're out there, you're in housing with the 10-year yield falling today because of, in your opinion, because of the labor data, not just the inflation data, missing. What do you think rates are going to do this week? I mean, you had last week, you wrote an article almost every day where it's like brand new lows for the year, brand new lows for the year. Oh, 11-month low. And it just keeps, sometimes it's just by literally 1 basis point, but it is falling. So do you think we have more to go?
We are almost at the bottom end range of my forecast because I am still working with a Federal Reserve that is modestly restrictive.
Okay.
And that's the best advice I could give to loan officers and real estate agents is that we're the only, really the spreads getting better have helped us because if the spreads weren't even getting better, mortgage rates would even be higher this year. We are modestly restrictive. And the irony was when Powell actually said, well, we're looking through inflation because, we're not hiking rates. Homie, there was a 2018 paper that the Federal Reserve wrote and said, yeah, hiking rates into a trade war isn't the best situation because that can exaggerate, a short-term phenomenon that could be recessionary. So I don't know those two guys. Powell is going to leave soon, but this is what happens when you have conflict. And when you have a series of data lines that is trying to tell you that the labor market is this area, and then you have trying to do Godzilla tariffs in a very fast time and have absolutely cannot cut a deal. And now we don't even know if the Supreme Court, thankfully, the Supreme Court is actually going to start listening to these depositions and everything sooner. We'll see if they're illegal. This is chaos. And what happens with chaos? Uncertainty brings the 10-year yield lower, and supposedly the solid labor market and the greatest economy. It isn't funny. It's actually, if you think about it, the solid labor market and the greatest economy ever. And look where we are because labor data is softer than we want. But it is good to note that Myron actually wrote down that they believe that there's a lot of confusion with the tariffs, and that's why hiring is slowed down. It wasn't the population growth slowing down thing. Because population growth, you could have used that this year. But last year, I even said that last year. I said my revision, I was so much lower than everyone else on the job forecast. And I was like, okay, I'm just going to wait for the revisions to probably get it right. Now that's lower. So I cannot wait to hear what Powell says now, because there are some really revisionary things going on right now, even though some of us, Waller and other people, are saying, and what happened last time during the trade war? Deals were made, rates went lower, the economy picked up. We can change this. We have the power to do this, right? We don't need to extend this, slowdown. GDP is up 3%, 3.1%. Retail sales are still consuming, right? Even back then, as the economy was slowing down, everything was still intact. But now you're playing with fire, and those two need to figure something out, because they're both wrong. And mortgage rates would be higher if we didn't have tariffs, because the Federal Reserve would have stayed more modestly restrictive out here.
Well, you are not the only one who can't wait to hear what Powell says next week and what they decide. So we will be watching closely.
I'm breaking into the Fed meeting, and I'm going to become a reporter. You give me a HousingWire reporter pass and let me get him. And you should give me the first question out there. And I'm going to say, when did the aggregate data of these two sectors fall and you were telling people it was a solid labor market? When in history was this the case?
It's a good question. You're not getting a press pass from HousingWire, though, because you're not a journalist. You're a great analyst, though. We appreciate you. Thank you for being on. We'll talk to you again very soon. And thank you, Logan.